Hi everyone, and welcome to the May version of Lendy's financial update. If you joined us last month, we covered a lot of topics around the very start of the kind of COVID-19 pandemic and the work from home situation, and there was a lot of unknowns last month. This month, we want to kind of follow up on that, make sure that you guys have the best and the latest information. And to do that, we've invited Dave Hyman, who will join us. He's the CEO and co-founder of Lendy. And he's going to help us with a couple of questions around kind of the financial outlook in and around COVID.
Hey, Zara. Thanks for having me.
Thanks so much for your time. We'll probably just jump right into it. We had a couple of questions from some of our viewers from last month, and we just wanted to follow up on those questions. If anyone does have any questions or comments, please do fill that in down below, and we will try and cover those for you in next month's edition. But Dave, since our last video, there's probably been a number of big changes to the Australian economic situation. Really keen to get your thoughts on where do you think we're at? Is there more still to come? Are we at the top or the bottom of the curve, if you like? And what kind of impact are you seeing on the property market?
Yeah, so I think, overarchingly, it still is very, very early on in this crisis. I know it feels like, we've all been working from home or some variant of that now for 6 to 8 weeks. But it's very, very early days. What we have seen, though, is a massive and unprecedented sort of coordinated government stimulus around the world. And then when we focus in on Australia, we've seen the actions of the Australian government relatively quickly in relation to things like JobKeeper, which has meant that, where the unemployment rate was forecast to kind of hit the high teens, there was some analysts forecasting as high as 20%. We're now going to be more like the sort of 10 to 12%. Still yet to be seen, but clearly we're looking like we're coming out to the beginning of the other side. And the level of stimulus has been, as I said, it's been unprecedented. So there's been over sort of $200 billion worth of direct kind of fiscal stimulus straight back into the economy. And to put that into context, we're talking about a single-digit billion budget surplus before all this happened. So it's a material amount of money that's been pumped in through things like JobKeeper and others. How that plays in on the property market is interesting. So there was quite a few people forecasting relatively sharp and steep declines in both transaction volumes and values. I'll start with the volume side. So we have seen a dip in the number of properties listed for sale. So typically we'd see this time of year anywhere sort of around the 30,000 new listings on a sort of a rolling 30-day basis. And it is seasonally, as we come into the colder months, it is seasonally a period of the year when we have less listings. We've seen that dip down to sort of sub 15,000. So there's been a sort of 30-40% drop in the number of listings. At the start of the crisis, in terms of how those listings were clearing, we saw pretty sharp declines in the auction clearance rate. So off the highs we had early this year in sort of the 70-80% mark, we saw sharp falls down to sort of the 30s and 40s as the market was starting to sort of grapple with what was going on. But as we've moved into this more sort of digital auctions, reverse auctions, Dutch auctions, that sort of stuff, and private treaties, the traditional private treaties, we've seen that sort of stabilise more at the sort of 40-50% mark, albeit on a much, much lower base of auctions, given people are choosing to sell their properties using other methods now. In terms of prices, though, prices have been pretty stable. So there's quite a bit of data out. CoreLogic is obviously a good source for this stuff, and they do a rolling home value index. It was across the major capital cities showing sort of growth of 1 to sort of 2% kind of at the start of the year, and that's come down to sort of 0.5%, but we certainly haven't seen any sharp price falls just yet. I think the big test is going to come up in the next kind of quarter as really the full impact of that next wave of stock that would typically come on post the crisis period starts to wash through the market, and we'll really start to see actions from sellers who either had to sell or do people have a little bit more discretion and can wait till a little bit later in the year.
Yeah, I know certainly from my point of view as someone who's sort of in the potentially home buying market, it's also been really interesting to see that the real estate agents and the auctioneers moving to a digital approach and kind of really embracing that. So I think if there is still people out there who are ready to go, there's still ways that you can buy today.
Yeah, I mean, what we've seen on Lendy in particular, just looking at our data, and this is really sort of really what we call front of the funnel, or people who are sort of really in that early research phase, is we've seen a pretty sharp increase actually of people kind of getting their finances in order. All we've really seen though is, or sort of underlying that though, we've seen a change in sentiment in terms of when people are looking to buy. So there's actually more people in the market from our data than there was sort of 12 months ago. They're just looking to buy a little bit later on in the year and waiting to see how things sort of pan out a bit more. You know, the digital tools, it's been really interesting. These sorts of, and certainly one of the green shoots from this crisis has been the speed at which a bunch of different industries, in particular the property industry, has moved to adopt digital tools like the digital auctions, the 3D walkthroughs, all that sort of stuff. You know, that was moving at a pretty snail's pace before this.
Yeah. Great to see. I guess on the flip side of that, you've obviously got quite a significant rental market, both a mix of kind of long-term residential rentals, but then also some of your kind of short-term holiday style Airbnb rentals, assuming that they've obviously taken a significant hit. What are you seeing on the Lendy end around that? And also just more generally, I guess, from that rental investment market?
Yeah, we've definitely seen a decrease in the number of, like, as a starting point, a decrease in the number of investors in the market looking to buy. And I think in particular for that part of the market you described, you know, if you're an investor who has bought a coastal holiday unit in somewhere like Bondi Beach and Byron Bay, you know, it doesn't take a genius to work out that, you know, our borders are closed and those people are going to be under lots of pressure. So where they typically would be, you know, relying on Airbnb or stays or whatever they were using for holiday rental as their income to pay their mortgages, no doubt they've seen pressure. And we'll start to see, I think, over the next few months, some supply opening up in those parts of the market and potentially some price or pressure on prices anyway. But that's going to be a real test over the next couple of months. We've certainly seen, I guess on the flip side, we've seen a large number of those properties that would typically be short-term rental to holiday makers back on the rental market. I think Bondi Beach was up by about 70% year on year in terms of total rental listings, and Byron was over double the amount of listings that they typically had for rent. So you're seeing people shift from this sort of short-term holiday rentals to looking for some more longer-term tenants, just given the current economic environment.
Yeah, absolutely. And last time we spoke, there was a lot of kind of discussion around the response from the government, and in particular the response that the banks and lenders would take as well regarding things like mortgage holidays or bailouts and things like that. What have you seen in those areas, you know, in terms of people choosing to take a mortgage holiday or choosing to refinance, given these are some pretty incredible interest rates that we're seeing at the moment?
Yeah, so firstly on the mortgage holidays, you know, this is one of the things I was really impressed with, and I may have mentioned this in our last chat, was the speed at which the banks moved to really quell any sort of issues with sentiment from people with mortgages, in particular at the early stages when companies were laying off 5, 10, and sometimes 20,000 staff in one foul swoop. And what that's meant is there has been certainly an uptake in these mortgage holidays. When we have conversations with the banks, you know, somewhere between sort of 5 and 10% of their mortgage holders are on holidays at the moment. And what that really means, though, is that you've got people sort of accruing interest on their loans and not making payments. Certainly better than the flip side, certainly better than them being in situations where they're defaulting on their loan, given the job losses. The other side of the coin here, though, is one of the pieces of non-fiscal stimulus, so sort of, but government stimulus nonetheless, was the RBA put in place what's called a term funding facility for the banks. It's a $90 billion facility that gives the banks access to very, very low capital that they can lend out to really encourage continued lending, obviously where it's responsible for the purpose of purchasing or refinancing, among other things. And what we've seen has been a massive uptake of refinancing in the current market. We've seen double-digit increases year on year, and certainly when we look at the drivers around that, because of this term funding facility, a lot of the banks have fixed rates now in the low 2% range. The cheapest on the Lendi platform is 2.09%. And when we sort of take a step back and reflect on that and look at where sort of mortgage rates were last year, we certainly didn't have fixed rates or even variable rates in the 2s. And the best rates were sort of in the low to mid 3s. So when you look at that environment in such a quick period of time, if you're an owner-occupier who hadn't refinanced, there's never been a better time. And I think we've certainly seen people voting with their feet to do so, which has been great to see.
Yeah, that's really positive. And just extraordinary rates. I don't know if we'll ever see them this low again in our lifetime. So I think if you are a refinancer or a potential refinancer out there, it's probably now's the time to have a good look around and see what you can get. Well, that's amazing. Thanks, Dave. That's such a good overview of kind of the market and what you're seeing on the Lendi end. Hopefully everybody found that really useful. If you guys have any key questions that you want Dave to answer or provide a point of view, you can just go ahead and comment below. We're really keen to hear what you guys want to know about to make a more informed decision. But as always, subscribe to our channel, hit the bell to get notified when we update our content and provide new content. And you can also check out our other useful videos as always. So there's mortgage repayments holiday or how to save money during COVID-19. But thanks again for joining us, Dave. Thanks for all those insights. And we'll see you again soon.
Thanks so much for having me on.